Question 21. The risk-free rate is 4% and the required return on the market is 12%. What is the required return of an asset with a beta of 1.5? For the risk-free rate is 4%. The beta is 1.5. And the market rate is 12%. And again, the risk-free rate is 4. To solve, we take the risk-free rate plus the beta and multiply that by the market value minus the risk-free. Gets us a value of 16%. Question 22. What is the required return on a portfolio consisting of 40% on the asset above and the rest in the asset whose return are perfectly correlated to the market? So 40% is 0.4, and for stock B it would be 0.6. The return is 16% for stock A and 12 for stock B. And the weighted returns is the weight times the return. Sum the weighted returns together to get a value of 13.6%. Question 23. Alpha Consulting has 10,000 shares outstanding, currently priced at $20 per share. They also have 500 bonds outstanding with a semi-annual payment and a coupon rate of 7%. The bonds currently sell at par and have 10 years to maturity. The beta of a company is 0.9 and the market risk premium is 4%. Treasury bills currently yield 7%. Ignore the effect on taxes. What is the WACC of the company? We had 10,000 shares of stock and 500 bonds. They were priced at $20 per stock, per share of stock, and 1,000 per bond. The value is the units times the price. And we need to find the total value. Equals 700,000. The weight is the value divided by the total value. And before we do return, we'll move down here with a risk-free rate of 7%. The beta is 0.9. And the market value minus risk-free rate is 4%. Risk-free rate plus beta times the market value minus risk-free. Gives us 10.6%, which is the return of the stocks. And the bonds return is 7%. The weighted returns is the weight times the return. And the final answer is the sum of the weighted returns to get us a value of 8%. Question 24. Which of the following is not an accepted way to manually adjust WACC for a division of a diversified company whose risk level does not match that of an overall firm? Pure play method, subjective approach, or flip a coin method? The answer is C, flip a coin. Question 25. Golden Enterprises has 50,000 shares outstanding, of which 20% are preferred shares and 80% are common shares. The preferred shares pay $2 per year in dividends and are priced at $40 per share. The last dividend paid to common stockholders was $5.8, and the company expects no further growth. The current price of a common stock is $80. The company currently has no long-term debt. What is the average cost of capital for Golden Enterprises? We had 50,000 shares, of which 20% are preferred, which is 50,000 times 20% is 10,000. And the stock is 40,000. The price of stocks is $20, and for preferred is 1,000. The value is the units times the price. And we want to find the total value. Sorry, the price of the preferred is 40. To get a total value of 800,000 plus 400,000 goes at 1.2 million. The weights is the value divided by the total value. The return is the $5.8 divided by the $80 common stock. And for the preferred, it's the $2 dividend divided by $40 per share. The weighted returns is the weight times return. And then the final answer is the sum of the weighted returns to get us a value of 6.5%. Question 26. French corporation has 500,000 shares of common stock that sells for $25 per share and has a beta of 1.5. The risk-free rate is 4% and the market return is expected to be 12%. The company has 10,000 bonds outstanding with a $1,000 face value, $1,100 market price, and a yield of 4.5%. There are also 100,000 shares of preferred stock that pay a $3 annual dividend and sell for $30 per share. Ignore the effect of tax rate, i.e. assume the tax rate of 0%. What is the French corporation's WACC? And assuming a 20% tax rate, what is the French corporation's WACC? The stock is 500,000 units. Bonds are 10,000. And preferred is 100,000. And that's the same for both parts of the question. The price per stock is 25. Price per bond is 110, or 1,100. And for preferred, it's $30. The value is units times price. And we want to find the sum of all the values to get a total value of $26,500,000. The weight is, the weight is the value divided by total value. These values are the same. The returns are how it's different. For the stock, in the no tax rate is the 0.04 plus the 1.5 as a beta. It's multiplied by the market value of 0.12 minus the risk-free rate, 0.4. .04 gives a value of 0.16. For bonds, it gets us 4.5%, which is 0.045. And for the preferred is $3 annual dividend divided by $30 per share. The weighted return is the weight times the return. And we find the sum of the weighted returns. For part A of the zero tax rate, we got 10%, 10.5%. For part B, in the 20% tax rate, the returns are different. So the stock is the same as part A. But the bonds are different, as it's 4.5% times the tax rate. 1 minus 20%. Preferred stock is the same, $30 divided by 30. Weight times return. And the sum of all the weighted returns . For the 20% tax rate, the French corporation is 10.2%.